My role here is to keep the conversation going, but unfortunately, we have monetary policy on Tuesday, and I'm supposed to be quiet about anything that's related to monetary policy. So I'll hop in on the things that I don't know anything about, but stay away from much of economics, except the really long term. But India is, as you know, going through a period of turmoil, where growth has slowed. We're, I think, in the process of stabilizing. But there's a lot going on in the economy. And perhaps we can start by talking a little bit about the Indian economy, move on to the global economy and the interactions, and then talk about the big uncertainty that faces us over the next few months, which is elections. We can start with the economy itself. Chanda, what do you see? What do you think is going to happen? What are your worries? What are your hopes?
Well, I think India has always had two drivers of growth: the demographics and opportunity to invest. And while demographics continues to remain our fundamental strength and has the potential even going forward, currently it's really the investment driver that has slowed down substantially. And the slowdown in the investment driver is not because there is no demands for the produce from the projects that would be set up, but it's really because decision making in the country has slowed down, approvals are not coming on time, and so on. So I think the big challenge and the requirement rather for the economy is to revive the investment driver. But if you look at the past 6 months or so, I think actually some positive steps have been taken. There's a whole lot of anxiety and acceptance in the form of the government, to start giving some approvals. I think the country's done very good work under the leadership of RBI to actually bring the current account deficit under control, to bring the exchange rate in stability. The fiscal deficit part is actually now looking much to be within the targets. The export-oriented industries are doing better. We've probably bottomed out as far as the GDP growth is concerned. But each of these factors that are looking good today cannot really revive the economy in a very big way unless we really bring back investments.
One of the big worries that emerging markets like us have is, of course, what the consequences of Fed tapering are. And Randy, you've been a governor at the Fed. You've spoken a lot about monetary policy. Should we be worried? And what should we do?
The challenges of Fed policy for the world are not just to say, well, we need to stop what the Fed is doing because it's going to have an impact on us. It's how do we make our systems more robust so that when changes do come, we can be resilient to those changes. And I think India is an example of how some of those changes have occurred. Is it perfectly resilient? Well, no country is perfectly resilient to these changes. But I think just very gradual pace of change of the Fed's policies led to big impacts. It's possible that in 2015 interest rates may start to rise. There could be some more impacts there. But I think since this has been telegraphed out for so long, hopefully individual countries will have more opportunity to get ready for that.
And here in India we have, especially on the public sector banks and not in the private banks, growing non-performing assets. Hopefully they will stabilize, but it has become somewhat of an issue. Do you think bankers are to blame here? What's going on?
I think the big concern around banking today is the quality of assets. Now the issue is, where should the anger lie? We must remember that we're talking of an economy that was just about 8 quarters or so ago growing at 9% per annum, and from there on has sharply adjusted to 4.5% per annum. I think that kind of adjustment has an impact all around on the entire economy and therefore on the quality of assets. The second is that as these assets were being built up, and the banks were participating in financing these projects, those were based on certain assumptions that approvals will come on time, assumptions that the power projects will get completed in 30 months, assumptions that even after they are completed, coal would be available, and so on. I think a lot of things have happened outside of the control of the bankers that have changed these assumptions. And that's why the quality of those assets is not as good as what was envisaged at that point in time. So I think when today, we look at the concern, we should look at the fact that it's the entire ecosystem that has moved in a direction which was very different from what was thought of, and that's why the assets are where they are. The retail side, the consumer side of the assets is continuing to perform in a very stable manner. The loss rates there, irrespective of what happens to the growth rate, is actually very much under control, partly because of the reasons as I mentioned. People have their jobs, people want to pay up their loans, people want to live peacefully in their homes and drive the cars for which they have taken the loans. As far as the large projects are concerned, clearly these projects are not generating the cash flows that they were supposed to generate by now. Projects are complete, but they don't have the raw material, they don't have the connection, the backward linkages, so they're not generating cash flows. Leverage levels have gone up. But at this time, if the bankers hold the hand of the intrinsically viable projects, I think these projects will grow out of their problems as the economy grows.
So you essentially giving hope and also saying that every bad loan doesn't mean it's an act of corruption or an act of incompetence. It could be just bad luck. And bankers are meant to take risks, and risks sometimes end up going the wrong way.